Imagine standing at the pharmacy counter to pick up a prescription and your debit card gets declined. You check your balance on your phone right there in line. The money is there, the account is simply locked. In 2026, this is happening to seniors more often than at any point I can remember. And not because anyone did anything wrong in the traditional sense. It's because of 5 specific things that trigger a bank's fraud system. And once you understand what they are, you can genuinely avoid most of these situations entirely. I'm Linda Foster, and I want to walk through exactly what's changed in how banks handle accounts in 2026, why these freezes are happening more frequently than ever, and the 5 specific behaviors worth stopping or changing right now to keep your money accessible. Let me start with the broader picture because understanding why this is happening makes the specific advice make a lot more sense. Banks are under enormous pressure to stop elder financial fraud, which costs Americans an estimated $3 billion a year. In response, more than 30 states have now enacted or strengthened what are called safe harbor laws, which give banks legal immunity when they freeze an account in good faith because they suspect a senior is being scammed or coerced. Before these laws existed, banks were genuinely hesitant to interrupt a transaction because they could be held liable if they were wrong. Now, that fear has largely disappeared, and the result is that banks and the artificial intelligence systems they rely on have become far more aggressive about freezing first and asking questions later. This is well-intentioned. Nobody wants scammers draining a retiree's life savings. But the systems built to catch fraud often can't tell the difference between a genuine scam and an innocent family transaction, which means completely legitimate seniors are increasingly getting caught in the same net designed for criminals. Here are the 5 things worth stopping, or at minimum, changing how you do them. Number 1. Stop making large or unusual transfers without telling your bank first. This is genuinely the single biggest trigger. If you withdraw a large amount of cash to pay a contractor, or send several $1,000s to a grandchild as a gift, or wire money for any reason that's outside your normal pattern, banks are now using artificial intelligence to analyze what some institutions call your financial heartbeat. The system looks at your typical spending, your typical transfer amounts, and your typical timing. When something breaks that pattern, even something completely legitimate, it can trigger an automatic hold, sometimes lasting up to 14 business days under newer state laws. The fix here isn't complicated, but it does require a change in habit. If you know you have a large transaction coming up, whether it's a wedding gift, a down payment, or a one-time payment to a contractor, call your bank 48 hours in advance. Tell them the exact amount, who's receiving it, and the purpose. This single step, sometimes called pre-clearing a transaction, dramatically reduces the chance of an automatic freeze because you've given the bank context before the algorithm ever sees the transaction in isolation. Number 2, stop ignoring letters from your bank, even ones that look routine. A lot of seniors receive bank correspondence that looks like standard paperwork and set it aside without reading it closely. Some of these letters are actually early warnings tied to federal banking rules. If your bank needs to verify your identity, for example, because your ID has expired, your name has changed, or there's a mismatch in your Social Security information on file, and you don't respond, the bank can freeze the account as a precautionary measure while they wait for you to update your documentation. The fix is straightforward. Open and read every piece of bank correspondence, even if it looks routine, and respond promptly if it's asking for updated information. If you're ever uncertain whether a letter is genuinely from your bank, the safest move is to call the number printed on the back of your debit card, never any number provided in the letter itself, and ask directly. Number 3, stop letting accounts sit completely untouched for extended periods. Many people keep a rainy day savings account they rarely access, assuming it's simply sitting there safely until they need it. But banks are increasingly aggressive about flagging accounts with no activity as dormant. And here's the detail that catches people off guard. Automatic transactions, like interest being deposited into the account, generally don't count as activity in the bank's eyes. If you haven't physically logged in, called, or made a withdrawal or deposit in 12 to 24 months, depending on your state, the bank may freeze the account and begin preparing to send the funds to the state as unclaimed property, a process called escheatment. I've heard from people who went to use an emergency fund they'd been quietly building for years, only to discover the account had been closed and the money sent to the state treasurer. Getting it back at that point requires filing a claim with your state's unclaimed property office, which can take months. The fix is simple. Log into any account you rarely use at least once every 6 months, even if it's just to check the balance. And consider making a small, deliberate transaction periodically, a modest deposit or withdrawal, specifically to keep the account showing genuine activity. Number 4, be extremely cautious about adding joint owners or a power of attorney without proper documentation. When ownership of an account changes, whether you're adding a joint owner, adding someone with power of attorney, or a spouse passes away and the account needs to transfer, banks can freeze access until they're fully satisfied about who legally controls the funds. This is meant to prevent exactly the kind of elder exploitation these new laws are designed to stop. But it can also catch completely legitimate situations in the same hold. If you're adding a trusted family member to your account or establishing a power of attorney, do it through proper, complete documentation and ask your bank directly what specific paperwork they require before you begin the process, rather than assuming a simple form will be sufficient. If you're navigating an account after a spouse's death, having a death certificate and any relevant estate documents ready from the start, rather than gathering them after the bank has already placed a hold, speeds up the resolution considerably. Number 5, stop using unfamiliar payment apps for large amounts without easing into them gradually. If you've primarily used checks and standard bank transfers for decades, and you suddenly start using something like Zelle or Venmo for a large amount, that sudden shift in behavior is exactly the kind of pattern fraud detection systems are trained to flag. According to banking security experts, a sudden change like this is often one of the first signs of a romance scam, or what's sometimes called a grandparent scam, where someone is being coerced or deceived into moving money quickly through an unfamiliar method. The system doesn't know whether you're being scammed or simply trying a new app for a legitimate reason, so it treats both possibilities the same way, by freezing the transaction. If you want to start using a newer payment method, start with small amounts first. Let the bank system see a pattern of normal, smaller transactions before attempting something large. And if you do need to send something large through a new method, that's exactly the situation where calling ahead, as I described in the first point, matters most. Let me go deeper into a few of these, because I think the practical mechanics genuinely matter here. On the pre-clearing process specifically, I want to address what actually happens when you call ahead. You're not asking for permission in the sense of needing approval to spend your own money. You're providing context that the bank's fraud system can attach to the upcoming transaction, so that when it does occur, it matches an expectation already on file, rather than appearing as a complete surprise. Building a relationship with your local branch, where staff recognize you and understand your typical financial patterns, also genuinely helps, since human judgment can sometimes override an overly cautious algorithm in ways that a purely automated review cannot. I also want to address something specific about what happens once an account is actually frozen, since knowing the process removes some of the panic if it happens to you. Unlike older systems where a single phone call might clear things up quickly, current rules often require a formal internal review before funds are released. And if the bank's underlying concern persists, this hold can be extended. The first thing to do if you discover a freeze is to confirm specifically what documentation or verification the bank needs from you. Gather any records related to the transaction in question, recent transfers, deposits, or unusual activity that might have triggered the review. And if you believe the bank is mishandling the situation or taking an unreasonably long time, you have the right to file a complaint with the Consumer Financial Protection Bureau or your state's banking regulator. I want to mention something that's genuinely useful as a backup strategy, regardless of how careful you are about avoiding triggers. Maintaining a second account at a separate institution means that if one account gets frozen, you're not left with zero access to any money at all while the situation gets resolved. This isn't about distrust of your primary bank. It's simply practical redundancy, the same way you might keep a spare key somewhere other than under your own doormat. Let me also address something specific about debit card freezes versus full account freezes, since these are sometimes confused. A locked debit card typically blocks ATM withdrawals and purchases, but your underlying account can still receive deposits, including Social Security payments, pension deposits, and other direct deposits, since these route through your account number rather than through the card itself. This is genuinely useful to know because discovering your debit card has been declined doesn't necessarily mean your entire account and all incoming payments are affected. Checking your account balance directly, separate from trying to use the card, tells you whether the issue is isolated to card access or whether it's a broader account hold. I also want to address why even something as simple as using your debit card while traveling can trigger a temporary restriction. If you typically make purchases in one geographic area and you suddenly use your card in a different state or country, that geographic mismatch is exactly the kind of pattern banks monitor for. If you're planning travel, calling your bank ahead of time to let them know where and roughly when you'll be using your card reduces the chance of this specific kind of freeze considerably. Let me close with the broader point that I think ties all 5 of these together. None of this is about your bank trying to make your life difficult. These systems exist because elder financial fraud is a genuine, serious, and growing problem, and banks are responding to real pressure to stop it. But the unfortunate side effect is that the same systems designed to protect you from scammers can occasionally treat your own legitimate financial life as suspicious. The single theme running through all 5 points today is this. In 2026, access to your own money isn't something you can simply assume will always be there without any effort on your part. It's something you maintain through staying in regular contact with your bank, responding to their correspondence, keeping accounts active, handling ownership changes properly, and easing into new payment methods gradually rather than suddenly. If this was useful, share it with someone in your life who manages their own banking and might not yet know about these specific triggers. A single conversation now, before an unexpected freeze happens, is worth far more than trying to untangle the situation after your card's already been declined at the pharmacy counter. I want to go even deeper on a few of these triggers, because the more specific you understand the pattern, the better positioned you are to avoid an unnecessary freeze without changing your actual financial behavior in any meaningful way. On the large transfer issue specifically, I want to address brokerage and retirement accounts, since the rules here have actually become stricter than for standard checking and savings accounts. If you have an IRA or a brokerage account and you attempt a large withdrawal or transfer, updates to FINRA Rule 2165 specifically allow firms to place temporary holds on disbursements from accounts belonging to seniors when there's reasonable suspicion of financial exploitation. This is separate from, and often more stringent than, the rules applying to a standard bank account. If you're planning a significant withdrawal from a retirement account, whether for a major purchase, a gift, or simply rebalancing your finances in retirement, calling your brokerage or financial advisor ahead of time, the same way I described calling your bank, applies here too, and arguably matters even more given how this specific rule is structured. I also want to address something specific about designating what some banks now call a trusted contact. This is different from a power of attorney, which grants someone legal authority over your account. A trusted contact is simply someone the bank can reach out to if they have concerns about unusual activity on your account, without that person having any actual access to your money. Establishing this in advance, before any issue arises, gives your bank a release valve, a way to verify a transaction is legitimate by reaching someone you've specifically authorized them to contact, rather than simply freezing first and leaving you to sort it out entirely on your own afterward. Ask your bank directly whether they offer this option, since not every institution markets it clearly, even when the feature exists. On the dormant account issue, I want to address a specific situation that catches a lot of people off guard, involving accounts opened for a specific, infrequent purpose. If you have an account you only use once a year, for instance to pay an annual insurance premium or a property tax installment, that pattern of infrequent but genuine use can still trigger dormancy flags depending on your specific bank's threshold and your state's escheatment timeline. Understanding your bank's specific definition of activity, which can vary meaningfully from one institution to another, and from one state's unclaimed property law to another, is worth a direct question to your bank, rather than assuming a single national standard applies everywhere. I also want to mention what happens if an account has already been flagged as dormant or even transferred to the state before you realize it. If you discover an account has been escheated, meaning the funds were sent to the state treasurer as unclaimed property, the money isn't permanently lost. Every state maintains an unclaimed property database, and you can file a claim to recover funds that were sent there. The process typically requires proof of identity and proof that the account was originally yours. And while it's recoverable, it can take weeks or months to process, which is exactly why preventing the escheatment in the first place, through periodic account activity, is considerably easier than recovering funds after the fact. On the joint ownership and power of attorney issue, I want to address something specific about what happens when a spouse passes away, since this is one of the more emotionally difficult situations where a sudden freeze can compound an already painful time. When a bank learns of a death, whether through a death certificate you provide or through other notification channels, they're required to verify who has legal authority over the account before releasing funds. If the account was held jointly with rights of survivorship, this process is typically faster, since the surviving spouse already has a clear, documented legal claim. If the account was solely in the deceased spouse's name, the surviving spouse or the estate's executor will need to go through a more involved process, potentially including probate documentation, before the bank releases the funds. Having your accounts properly structured before this situation arises, understanding clearly which accounts are jointly held versus solely owned, and keeping basic estate documents like a will or trust paperwork organized and accessible makes an already difficult moment considerably less complicated when it eventually happens. Let me also address something about how to actually verify whether a letter, a phone call, or a text message claiming to be from your bank is genuine, since scammers have become increasingly sophisticated at impersonating exactly the kind of official communication I've described today. Never use a phone number, a link, or a reply option contained within the suspicious communication itself. Always independently look up your bank's official customer service number, either from the back of your debit card, a recent genuine statement, or your bank's official website typed directly into your browser, and call that number to verify whether the original communication was real. I want to close this deeper section by addressing something I think is genuinely important context. The frustration many seniors feel about these new, more aggressive freeze policies is completely understandable. Being locked out of your own money, even temporarily, even for good reasons, is stressful and can feel like an overreach. But the alternative, a banking system that does nothing to interrupt obvious fraud patterns, has its own enormous cost, measured in the billions of dollars seniors lose to scams every single year. The goal isn't to eliminate these protective systems. It's to understand them well enough that your own legitimate financial life moves through them smoothly, while the protections themselves remain in place for situations where they're genuinely needed. The 5 things to change starting today. Call ahead before large or unusual transactions on both standard bank accounts and retirement or brokerage accounts. Open and respond to every piece of bank correspondence promptly. Keep dormant accounts active with periodic check-ins, even small ones. Handle joint ownership and power of attorney changes with complete, proper documentation, established before you need it rather than scrambled together afterward. And ease into new payment methods gradually, with smaller transactions before larger ones, while calling ahead for anything genuinely large and unfamiliar. If this was useful, please share it with someone in your life who manages their own banking, particularly if they're the kind of person who tends to set bank letters aside without reading them closely, or who keeps a savings account they rarely check. A single conversation about these 5 specific things before an unexpected freeze happens could save them a genuinely stressful week. Let me add one more piece that I think rounds this out properly, because I want to address the emotional side of this, not just the practical mechanics. If your account does get frozen, even temporarily, it's worth recognizing that the experience can feel genuinely jarring, even frightening, particularly if you're living on a fixed income and suddenly can't access funds for groceries, medication, or a utility bill. That reaction is completely normal, and it's worth giving yourself permission to feel frustrated by it, even while understanding why the system exists in the first place. What I'd encourage you to do in that moment is resist the urge to panic or to immediately assume something has gone catastrophically wrong with your money. In the vast majority of these cases, the funds themselves are completely safe. They simply aren't accessible for a period while the bank completes its review. Calling your bank directly, using the verified number from your card, and calmly asking what specifically triggered the hold, and what documentation would resolve it fastest, tends to produce far better outcomes than escalating frustration with frontline staff, who often have limited ability to override an automated system on the spot. If the initial conversation doesn't resolve things quickly, asking specifically to speak with a supervisor or a member of the bank's fraud or compliance department, rather than continuing with general customer service, often moves things along faster, since these are the people with actual authority to review and potentially release a hold once they're satisfied the activity is legitimate. I also want to mention that if a freeze is genuinely creating a hardship, unable to pay for essential medication or utilities, communicating that specific urgency clearly to the bank, rather than simply expressing general frustration, can sometimes expedite a review. Banks generally don't want to be the reason someone misses a medication or has their utilities cut off, and making the real-world stakes clear, with specific details about what bills or needs are affected, gives the person handling your case a concrete reason to prioritize your situation. Let me leave you with the broader perspective I think matters most here. Banking in 2026 genuinely requires a bit more proactive engagement than it did even 5 or 10 years ago, specifically because the fraud landscape targeting seniors has become so much more sophisticated and so much more costly. This isn't a burden that exists because anyone thinks less of your judgment or capability. It exists because the people trying to exploit seniors financially have become genuinely more sophisticated, and the protective systems built to counter them are still working out the balance between stopping criminals and not inconveniencing the honest majority of people they're meant to protect. Staying a few steps ahead of these systems through the 5 specific habits I've described today: calling ahead, reading your mail, keeping accounts active, handling ownership changes properly, and easing into new payment methods, is genuinely the most effective way to keep your own money accessible while these protections continue doing their job against the people they're actually meant to stop. If this was useful, please share it with someone in your life who manages their own banking independently. I'll see you in the next one.